Critical Man Pictures presents the Forex video training series. Greenbelt Moving Average. A moving average is simply a way to smooth out price action over time. By moving average, I mean that you are taking the average closing price of a currency pair for the last X number of periods. If plotted on a chart, it would look like the chart listed. Like every indicator, a moving average indicator is used to help forecast future prices. By looking at the slope of the moving average, it is used to help us forecast where the pair may go. Moving averages smooth out price action to make it more manageable and easier to follow. There are different types of moving averages, and each of them has their own level of smoothness. Generally, the smoother the moving average, the slower it is to react to the price movement. The choppier the moving average, the quicker it is to react to price movement. To make a moving average smoother, you should get the closing prices over a longer period of time. In this section, you'll learn there are two major types of moving averages, simple and exponential. You will learn the pros and the cons of each, but first you'll need to know the basics. In the chart, a simple moving average is the easiest type of moving average to calculate. Basically, it is calculated by adding up the last X periods closing price and then dividing that number by X. If you plotted a 5-period simple moving average on a 1-hour chart, you would add up the closing prices for the last 5 hours and then divide that number by 5. You now have the average closing price for the last 5 hours. String together those average prices and you get a moving average. If you were to plot 5-period simple moving average on a 30-minute chart, you would add up the closing prices of the last 150 minutes and then divide that number by 5. If you were to plot the 5-period simple moving average on a 4-hour chart, yes, we know, you get the picture. Most charting packages will do all the calculations for you. The reason you are just bored with how calculating simple moving averages is because it is important to understand so you know how to edit and tweak the indicator to fit your own charting style. Understanding how an indicator works means you can adjust these settings and create different strategies as the market environment changes. Now, just like any other indicator out there, moving averages operate with a delay. Because you are taking the average of past price history, you are really only seeing the general path of recent past and general direction of what could be future short-term price action. A disclaimer, moving averages will not turn you into Miss fucking Cleo. Here's an example on how moving averages smooth out price action. On the chart listed is a daily chart of the dollar-yen. As you can see, the longer the SMA period is, the more it lags behind current price. Notice how choppy the 10-period SMA is, the yellow line, that the 21-period SMA, the blue line, is medium smoothness level, and the 50-period SMA, red line, is more like a gradual slope. You'll notice on the chart that the current price has intersected the 50-period SMA. Think a possible trading opportunity has emerged? We'll get to that later. The SMAs in the chart show the overall sentiment of the market at this point in time. Here, we can see exactly what the pair is doing. Instead of just looking at the current price of the market, the moving averages give us a broader view, and we can now gauge the general direction of its future price. With the use of SMAs, we can tell if the pair is trending up, trending down, or just ranging. There's one problem with the simple moving average, and that is it's susceptible to spikes. When this can happen, it can give us false signals. We might think that a new trend may be developing, but in reality, nothing has changed. The exponential moving average can help us eliminate spikes in price action that would have distorted the simple moving average. If you observe the daily chart on the dollar-yen, you'll notice that the third day is a shooting star candle. While the white line is drawn upwards to spike due to the third-day price, even though the price action continued down for a few more days before heading back up. If you would have acted, you would have falsely assumed that the price could have beginning a reversal. The exponential moving average gives more weight to the most recent prices. From the example, you can see how the EMA would more accurately represent recent price action. You can probably guess why this happens. It's because the exponential moving average places more emphasis on what's been happening lately. When trading, it's far more important to see what traders are doing now rather than what they were doing last week or last month. You probably ask yourself, which is better, simple moving average or exponential moving average? First, let's start with the exponential moving average. When you want a moving average that will respond to price action rather quickly, then a short period EMA is the best way to go. These can help you catch trends very easily and very early, more on this later, which will result in a higher profit. In fact, the earlier you catch a trend, the longer you can ride it and break in those profits. The downside to using exponential moving average is you may get faked out during periods of consolidation where traders are merely protecting their profits and price is not experiencing a reversal. Yikes. Because the moving average responds so quickly to the price, you might think a trend is forming when it could just be a price spike. This would be the case of an indicator being too fast for your own good. With a simple moving average, the opposite is true. When you want a moving average that is smoother and slower to respond to price action, then a longer period SMA is the best way to go. This would work well when looking at longer time frames, as it could give you an idea of the overall trend. Although the SMA is slow to respond to price action, it could possibly save you from major fakeouts. The downside is you may delay entry in a position too long, and you may miss out on a good entry price or miss out on the trade altogether. An easy analogy is to think of the SMA and EMA as the tortoise and the hare. The tortoise is slow, like the SMA, so you may miss out on getting in on the trend early. However, it has a hard shell to protect itself, and similar, using the SMA would help you avoid getting caught in fakeouts. On the other hand, the hare is quick, like the EMA. It helps you catch the beginning of the trend, but you run the risk of getting sidetracked by fakeouts. Which one is better? It's completely up to you, the trader, to decide. Many traders plot several different moving averages to give them both sides of the story. They might use a longer period SMA to find out where the overall trend is, and then use a shorter period EMA to find when a good time to enter the trend would be.